Hello, this is Justin Martin, one of the wealth strategists here at Paradigm Life. In this video, we will be discussing the infamous qualified plans. And there's many different types of qualified plans out there. Let me just bring up a quick screenshot here of some different types of qualified plans that you may be familiar with. I think most prominently we're looking at the 401k, the IRA, the 403b. It's these type of plans that are qualified. Now, I guess the first question is, who is qualifying these plans and what does that mean? Well, it's the IRS that is qualifying the plans. What they are allowing to have happen is they are allowing a person to contribute to one of these plans, and by they I mean the IRS is allowing someone to contribute to one of these plans and not have to pay tax at that time. Or as it is said, the IRS is allowing you to defer those taxes. Okay, so let me just go to the next screen here. So just a quick example here. Let's say your income is $100,000 a year, and let's say you contribute $10,000 of your income to your 401k, to an IRA, to some type of qualified plan. Then your taxable income to the IRS that year is $90,000. Okay, pretty simple. That's the plan we're talking about here. However, if we look at the IRS tax code governing these qualified plans, I guess we could use the adage, the IRS giveth and the IRS taketh, because the IRS qualified plan is not guaranteed, and the provisions of the plan can change at any time. I heard the anecdote shared to describe the qualified plan in this way. So if you came to me for a loan and I said, sure, I'll lend you some money, what would the next line of questions that you would ask me? Well, you'd probably ask me, what are the terms of that loan? Well, what if I came back to you and said, well, I don't really need the money at this time, so let's just figure out all the terms of the loan later on down the road. Now, nobody in their right mind would actually take that loan. But this is actually what you are doing with a qualified plan. You're putting your money into a qualified status, and you don't really know what the terms by which you're going to pay in the future. And what would dictate those terms of the qualified plan are whether or not the federal government needs that money. Okay, so in the future, if the government needs the money, then they can use the IRS tax code to change the terms of the qualified plan. Easy as that, all right? So when we're looking at these qualified plans, it's not an actual deferment of taxes, but I would say it's more of a postponement of a tax and the actual tax calculation. Okay. Again, we don't know what that amount will be in the future, what the taxes will be in the future. It just depends on the government's need for the money. Now, I'm not necessarily here to say whether a qualified plan is good, bad, or neither. But in this video, I want to discuss what a qualified plan is in order to help you understand if that financial strategy of contributing to a qualified plan works for you and if the risk is worth it. Okay? Some people may ask, well, what does it mean to even postpone the tax calculation? Well, let's start by asking two questions. Okay? Question number one is, what tax bracket will you be at in retirement? Okay? You have to realize that when you get to retirement, it's going to be too late to do any significant tax planning. Okay? But we have that risk involved of not really knowing what our tax bracket will be or what the tax system will look like in the future. The second question to ask is, what deductions will you have when you start taking the money, when you start receiving those distributions, those pension payouts from your qualified money? Most people, as they enter into retirement, we have to realize they've either paid off their home or they have nearly paid for the home, which is great. It's great to have that mortgage paid off, but we fail to realize that there's no mortgage interest deduction anymore on our taxes. Also, at that point in time, most people are empty nesters and so they're not receiving any deductions for having children still at home. Okay, so we have to be careful to assume that we'll either be in a lower tax bracket or have equal deductions in retirement to the same tune that we have right now. Okay. Now you'll notice that there's two buttons here at the bottom of my page. Let's click this first one here, this tax thresholds, because I want to talk a little bit in more detail about our current tax system. Okay. Now, as a disclaimer, I'm not a tax advisor, nor am I providing any specific tax guidance or recommendations to you. Make sure you please discuss any of those type of recommendations with your CPA or your tax advisor. Okay, but I believe this conversation is going to be, it'll help us as we start to determine if this financial strategy of qualified plan is really for us. Now, the data here on my screen is the historical data of the United States federal income tax brackets and also the threshold amounts. When discussing our taxes, it is important to know that we do not utilize a flat tax system. It's not everyone has to pay 30% tax, but we actually use a marginal tax system. Okay. For example, let me just scroll down here to the bottom. We have here tax brackets in 2016. Now, again, this is a little bit different for every person depending on how you file your taxes. But for the most part, when we look here, this initial tax rate, 10%, and a threshold for lowest tax bracket, $18,550. What does that mean? Well, this is basically saying if it's you, if it's me, if it's Bill Gates, all of us will be paying at a 10% federal income tax for the first $18,550 that we make. At that point in time, when we make another dollar, we now go up to the next tax threshold, the next tax bracket. Okay, and there's breakdowns all the way up until the very top rate. Okay, come over to this column now, the top rate of 39.6%, meaning once a person has hit the income threshold of $466,000, at that point in time, any dollar above that, 39.6% of it will be taxed and sent to the federal government. Now, this doesn't take into account state taxes, but this is the federal income tax bracket. Okay, so we're in this marginal tax system. Now, it's kind of interesting to see the way that Congress and ultimately now the IRS is kind of changing tax rates, changing thresholds along the way as we have this continual balancing act of how much money do they need. Okay, so if I start to scroll down the line here, you'll start to see the numbers change every so often. I mean, here's a significant change here. In 1942, all of a sudden, if we look at the top tax bracket, 1941, it was anyone that made over $5 million at that point was going to be taxed at 81%. Then all of a sudden, we head into World War II, and now that drops down to anyone making over $200,000 is taxed at 88%. Okay, so Congress can quickly change things up and change the IRS tax code a little bit. Okay, let me go over to another page here that'll paint the picture a little bit better. Let's go to tax history. Okay, so looking here, and I apologize for these small numbers and small bars, but looking here now, this actually shows us what is that top threshold amount each year since the federal government started the first income tax bracket, okay, which was in 1913. Basically, they said anyone in 1913 making over $500,000 was going to be taxed at 7%, okay? And then we quickly see that this temporary tax system actually hasn't gone away yet. It's actually been going up and down throughout the last 100 years. We can, this is kind of fun here to put on to show some of the major world events and U.S. events going on. For example, right here we have in 1918 World War I happening. We start to see tax brackets skyrocket. They come back down again. We have the stock market crash and the Great Depression, and ultimately we start heading into World War II, and we really see the tax brackets hit their peak that they've ever been at, up around 92, 93, 94% right here. Okay, and they bounce around. We've got the Korean War. They start to come down with JFK. And then with Ronald Reagan, they really just started to come back down quickly. And then over the last 20 years or so, we've had pretty constant tax brackets through the Clinton and Bush administrations. Okay, I think one thing that's notable here as we look at this is we've had the Afghani and the Iraqi wars over the last 10, 15 years, yet we haven't paid for them yet. So if history tells us or teaches us anything, we still need to pay that off here in the near future. Okay, so let's jump forward here. Now, I want to jump to my next screen here, and let's just look at some quick numbers as we start to go through this. So I want to take a look here and ask the question: do these qualified plans actually save taxes, or do they just defer them? Okay, and are those, if you do save taxes, are those tax savings real, or are they just apparent tax savings? Let's take a look here, okay? So let's say you've got your 401k and you're contributing, let's say we're putting $10,000 per year into your 401k. Let's also say you're in a 30% tax bracket, all right? And just to make sure we don't put too many variables into all of this, we're going to say at retirement, you're still at a 30% tax bracket. Okay, because really, I mean, in all reality, when we retire, we don't want to have to change our lifestyle completely. We're hoping that we can have the same lifestyle, if not better, when we enter into retirement. So we want to have the same kind of income, right? Now, for this calculation, we're saying you're putting this $10,000 away per year for the next 30 years. That's what we're going to calculate until you get to retirement. And let's also say, here's a disclaimer about rate of returns. I'm not giving you any kind of investment guidance. This may fluctuate over time, etc. But let's just say you find something that's going to give you 6% every single year for the next 30 years. Okay, you're getting this guaranteed 6%. If that were the case, then let me get out my drawing device here. Then at that point in time, we are saying that your account balance is now $838,000. Still pre-tax money. We haven't paid any taxes on it yet. So your amount to you is $586,000, and the amount going to the IRS is going to be $251,000. Okay, so that's where we are. You've deferred the tax, and that's how much you're paying. Now, these next two numbers here, we've got the apparent tax is deferred and the apparent tax is at interest. That $90,000 amount right here is saying every year your $10,000, of that $10,000 at a 30% tax bracket, $3,000 of that dollars you're saying is taxes, should go to taxes if you took it as income, but instead you can defer it, so you're plugging it into your 401k and getting a tax deferral on it. Okay. Now we're not just deferring that $3,000 amount. The IRS says, no, that $3,000 that you just deferred, it needs to be invested the same way you're investing all of your money. So when you start distributing the money, they get that interest also. Okay, so they get the $251,000. Now, if the withdrawal tax bracket increases, so let's come here. Oh, let me turn off my drawing device. There we go. If the withdrawal tax bracket increases, the government will receive a bigger piece of the pie. So let's say all of a sudden, let's say you're in the average tax bracket over the last 100 years would be 58%. Let's say we get the average tax bracket. If that were the case, okay, then the IRS gets the bigger piece of the pie. Again, look down here, amount due to the IRS, $486,000. Your share, $351,000. If the withdrawal tax bracket is lower, then we actually receive more tax benefit. Then we actually receive the bigger piece of the pie, more tax benefits than we anticipated. Okay, so let's say all of a sudden you're in retirement and you're in a 20% tax bracket. The IRS takes $167,000, you get $670,000. But remember, the key is that not only are you deferring the taxes, but you're also deferring that tax calculation. So it is important to know that when you're in retirement, where are those tax brackets going to be? Now, I hope that in the future that we can find a way to have that lower tax bracket. But again, that's the risk. That's the risk involved here. Okay. All right. Let's scoot forward here a little bit. Let me see if I can find my mouse again. There we go. Let's jump over this. Okay, so let's come back here. I want to take a look here. We're at this history screen again of our taxes. And I just want to plug in some simple numbers here to illustrate this one more time. Let's say at retirement, you have $1 million sitting inside your account balance. Okay? If there's no taxes on that money, your share of that money is $1 million. However, let's say we're at the high tax bracket, you're at 39%. You'll quickly see that your share versus the IRS share, there's that quick breakdown. If we go to the average tax bracket at 58%, quick calculation, okay, we've got the tax bracket, your share versus the IRS's share. So again, in retirement, we've got to be asking ourselves those two questions of what will the tax bracket be and what will my deductions look like? Okay? Now, some people will say to me, well, my company offers a Roth 401k, or I make contributions to my Roth IRA. Now, for those not familiar with a Roth IRA or a Roth 401k, this is a type of qualified plan that allows you to put after-tax money into the account and then let that money grow tax-free. Okay? So basically, you're paying the taxes on it, and then the rest of the money goes into some type of an account, a Roth account, where that money now grows tax-free. Well, would you be surprised to find out that the tax-deferred contributions to the account that are taxable when withdrawn, or in other words, your traditional IRA, your 401k, are the same as the after-tax contributions that are withdrawal tax-free, like your Roth or Roth 401k? You know, let's take a look here at the numbers, see if I can describe this a little bit better. You know, like our previous conversation or calculation, we're saying here, we're going to be putting $10,000 into a qualified plan. Current tax bracket 30%, withdrawal tax bracket 30%. We're going to save for the next 30 years. Okay, so we're going to compare now a traditional qualified plan to a Roth qualified plan to see if there is any difference. And when you look at it here, okay, tax deferred with a taxable withdrawal. So you're putting $10,000 in 30 years, you have $838,000. My drawing here to help paint this better. Okay, so you put $10,000 in, you've got $838,000 in there. Okay, so you're going to be able to have $586,000 to use in retirement. Whereas if you put that money into some type of a Roth vehicle, okay, you get a different color here. Now we're saying $7,000 is going in. Okay, so $3,000 was paid in tax. So now at the end, you're able to withdraw $586,000. As long as we're keeping the same tax bracket, holding all variables the same, the withdrawal is going to be the same. Now we can start to bounce tax brackets back and forth with all of this to find, you know, which one's better than the other. And again, it just depends on where those tax brackets are going to be bouncing around to. Okay. But it's important to know here, when we hold all these variables equal to each other with the tax brackets, that a traditional qualified plan versus a Roth qualified plan, the withdrawal amount that you get in the end is going to be the same. Okay, again, it's all about that deferred tax calculation, or the postponed tax calculation. Okay, let's go here to the next screen. So we just looked at that example of a traditional qualified plan versus a Roth qualified plan. We can start to run the numbers also with a qualified plan versus if you just took the money and put it into a taxable investment to figure out which is going to be the best. And let me just plug in all of those same numbers. Let me zero that out. So $10,000 per year over the next 30 years, 30%. So this is saying a traditional qualified plan versus you just taking $10,000 and plugging that into just a Fidelity investment account where you're going to invest, or an E-Trade account you're just going to invest. Okay. Interesting here. We've got, and I was just switching back and forth from a Roth versus a taxable. That's all I changed there. So we're going to start to show that in this scenario, holding investment returns and everything equal to each other, this person would be better off with a qualified plan instead of putting money into a taxable plan. Okay, and then we could throw a company match in there if we wanted to, and that's just going to accelerate it even more. Okay, so there's the next comparison for you. Okay, so let's come back here and let's review. Really, when it comes to these traditional qualified plans, we've got to be asking ourselves, not two, but now I'm going to add a third question. So first question, if I can find my mouse here. Here it comes. There we go. What tax bracket will you be in at retirement? If I'm in a lower tax bracket, I might win this bet, right? But I guess that also means I'm probably living on a lower amount of income. If I retire with a higher tax bracket, then I lose, right? The IRS gets the bigger share of the pie. Okay, so there's that risk there in trying to predict what tax brackets are going to look like at that point in time. Second question, what deductions will you have when you take the money? It's kind of ironic that it seems like the best time to have the deductions is when you actually have the money and you're using the money, but we no longer have that mortgage interest deduction or child deduction or anything else. Okay. Now, this third question, this is probably the most important question to be asking yourself. What is your exit strategy? How are you going to get all that money out of your qualified plan or your pension distributions without having to pay all of those taxes? Okay, because as of right now, the IRS, again, they're the ones that's in control. The federal government, depending on when they need the money and how badly they need the money, they're in control of the terms of your entire retirement assets in those qualified plans. Okay, so what is your exit strategy? And then ask yourself, what if there were a strategy that you could employ that you could either reduce or minimize the tax liability you have on your qualified plan? Is that a plan that you would want to talk about? And obviously, the answer is yes, absolutely. Okay, so let me ask that question again. What if there were a strategy that you could employ that you could either reduce or minimize the tax liability you have on your qualified plan or your distributions significantly? Would you want to talk about that? Well, that's what we're discussing here with this wealth maximization account. In the perpetual wealth strategy here, we're here to show you how you can be prepared for the future with your retirement income planning. And it's through this kind of account, through this wealth maximization account. Okay, so make sure you're jumping into these other videos and speaking with your wealth strategist to learn more about how you can properly plan for your taxes alongside the advice you're getting from your tax advisor in order to really maximize your wealth in retirement. All right, So thanks again for joining me here in this discussion about qualified plans. Again, I'm Justin Martin, one of the wealth strategists here at Paradigm Life, and want to thank you for joining me here.